Welcome to Investors Insights. Our topic today is rolling recession and rate hikes. I am joined by my distinguished colleagues today, Trey Booth, Bobby Norman, and Ty Miller. And we've got a lot of information to provide you that I think you'll find very beneficial. It's hard to believe that today is July 10th and 2023. In 6 months, we'll be in January 10th of 2024. A lot of information. Economic news is heading our way, and we're navigating through it. So I want to start off this morning, Trey. I'm going to come at you first because you talked about rolling recession and different sectors of the market, and I thought it was invaluable information our clients need to hear. So talk about that a little bit.
Yeah, thanks for. So that's a phrase. The phrase "rolling recession" is relatively new in terms of economics, but it's getting popularity. That the U.S. has been experiencing a rolling recession over the last few years, and maybe continue going forward. Not an economic-wide recession. So what does that mean? That means if you think back to last year, there were parts of the economy and parts of the country that were in a very deep recession, but it didn't spread economic-wide. So let's think back. Areas like San Francisco and New York have had a deep real estate recession. Areas like the technology sector had a very deep recession last year, and they may be coming out of it, but we're seeing a rolling recession in that new parts of the economy seem to be weakening. And so housing last year is very weak, but new housing construction so far this year is very strong. But we're getting commercial real estate's becoming very weak. And so it's not an economic-wide slowdown. It appears to be just kind of rolling across the country where there's a lot of strength in areas like Florida and Texas where real estate prices are strong, commercial real estate is strong. But if you look at areas like New York, where 40% of the central business district office buildings are, it's very weak. And so an interesting new concept where we may not see a economic-wide slowdown, which is harder for economists to kind of factor in and project, but we may see it in certain sectors. And so a good way to look at that is, and what kind of caused the discussion is we have earnings season coming up. And so earnings look backwards at what things were last quarter. And what was fascinating to us, you can see in this chart, is that revenues are expected to decline by 0.8%. The bigger number is earnings are expected to decline by 6.4%. But revenues declining is more interesting to us because in an inflationary environment, you would expect revenues, which are just top line prices, to go up with inflation. And then earnings to be harmed as prices don't outpace cost expansion. But in this scenario, revenues are actually declining. But again, it's not economic wide. You can see on this chart that certain sectors like financials and consumer discretionary are actually growing revenue. And certain sectors like energy and materials, which were booming last year, are seeing their revenue comparables year over year declining. And so this may be areas of weakness, which we've seen in the prices. The first half of the year, materials and energy underwhelmed. Maybe like last year, we should expect them to do well going forward from here, but still kind of shows a picture of maybe this rolling weakness. I know a lot of people will be surprised to see financials on there, but again, this is the S&P 500, so the largest 500 stocks. And so the financials may be a little misleading because a lot of the regional banks aren't included in here. And a point that Ty brought up on a previous vlog, JP Morgan at that point, the one JP Morgan financial was larger than all the regional banks combined. And so this is the biggest of the bigs. And so something to keep in mind there. Another point when looking at S&P earnings is the size impact. What's fascinating is the top 10 companies make up 30% of the index and make up 20% of the earnings. And so it's really been a narrowly focused stock market rally this year in some very specific companies. It appears that those rallies may have outrun their earnings. We've seen prices move a lot quicker than earnings. And so there may be some pullback, but something we're watching closely, using this data to look backwards to help us make decisions going forwards.
Yeah, and that's a lot of great data. And folks, I want to say this, what Trey has shared with you. Of course, we continue these discussions throughout our vlogs, but also in terms of social media as well. We're posting things on LinkedIn, Facebook, Twitter, on YouTube, in our podcast. And this is the kind of information and data that's constantly being presented here at Five Plan Partners. And Trey, I thought you did a great job putting all that together because I think that information is going to be crucial as we move forward in the next 6 months. You also talked about looking backwards. And Bobby, you did a great job just from a historical standpoint. You know, we like to say here at Five Plan Partners that history doesn't repeat itself, but it sure does rhyme. And so we look at similarities from a historical standpoint to just see what was taking place in previous years. So show the chart and talk about what you brought to the table this morning in our early morning portfolio strategies meeting.
Yeah, so the second half is off to a relatively slow start for the market as the market battles overbought conditions, and we've seen a rise in interest rates and economic resiliency, and especially with a tight labor market, has kept the Federal Reserve rate hikes on the table, which has led to more uncertainty in the market to start the second half of the year. So what we want to do is we want to look at what history says about the second half of the year after a good first half. It was great to see the market up in the first half, but the breadth of the overall market wasn't very strong. And as Trey mentioned earlier, we saw only a few stocks contribute to a lot of the market upside. So as you can see in this chart, what we did is we did some correlation analysis comparing the first half of prior years to 2023. And history is on the market side here. So of the 10 highest correlated first halves to 2023, going back to 1950, the S&P 500 generated average and median gains of around 12% in the second half, with 9 out of the 10 periods producing positive returns. The year that I want to focus on is 1995. It really stands out with a high correlation to 2023 and a relatively similar macroeconomic backdrop to now. If you think back to that time period, 1994, we saw market volatility, especially in the bond market, just like we saw last year in 2022. Going back to 1995, also a pre-election year, the Fed paused on an aggressive rate hiking cycle, and the soft landing helped drive the S&P 500 up 13.1% the second half of the year. So, of course, no guarantees, and this observational data comes from a lot of historical data, but it has a major asterisk, and the correlation does not always imply causation and same returns. But we continue to look at historical trends to see if similar market setups can contribute to our investment strategy for our clients.
Yeah, historical data is invaluable and can give us some insight. And just like you mentioned, 1994, that was a rough year for bonds. We experienced that last year with 2022 and into this year. And that's why I really appreciated also what Ty brought to the table on information in relation to the bond market. So often people want to talk about the stock market, but the bond market is very important in relation to our economy and also interest rates and financings. So Ty, talk about that in regards to what you're seeing on the bond market.
Yeah, so bond market, maybe not as fun to track as the stock market, but the bond market is massive compared to the stock market. So very important in our research. As you can see in this chart, yields on the 10-year and the 30-year bonds exploded last week to join the rest of the yield curve above 4%. 10-year sitting at about 4.05, 30-year right around the same. And one interesting thing that I want to kind of go to is something that we've been tracking for the last few weeks are these two charts. So we've specifically been tracking the 10-year and the 30-year. They've been kind of in these ranges, and they finally both broke out of those ranges. This chart is a little dated, but the 30-year did break out. And so as you see here, the 10-year, the new target is 4.35. We're at 4.05. That's still another 30 basis points, of room to go. And then the 30-year, we don't have a target for that, but, expect more of the same. How does this impact you? Well, to start off with, mortgage rates elevated. They're staying elevated right now with yields in the bond curve, yields and bonds for treasuries going up. That's going to result in the mortgage yield, which is about 6.81% national average right now, continuing to stay elevated. Number two, of course, is that when bond yields rise, the bond prices fall. And so that's something to always monitor. And then, of course, number three is we have a Fed rate hike decision coming up here at the end of the month. The Fed paused in June, which some people were saying, is it a pause? Is it a skip? Well, we have about a 92% chance, as you can see in this chart, of the Fed raising rates here at the end of the month. And so it looks like a skip. It's not a permanent pause. They skipped June. July looks like it's firmly on the table for another 25 basis point rate hike coming up. And so just something to keep an eye on, and then we'll kind of see what the Fed does from here with the employment numbers they're getting and the yields being the way they are.
For those folks out there that keep saying, when is the Fed going to start to lower rates? I think your information makes it quite clear. We're probably not going to see that anytime soon. And then from the standpoint, the question that we're being asked by clients, are we going to go into a recession? What Trey was talking about in terms of rolling recessions, a whole new concept that we may be seeing here. And we're going to be watching the historical data as well, as Bobby presented. So folks, these are all the pieces of the puzzle, the information, the data we're constantly researching to bring all this together, to coordinate it in relation to your financial blueprint and your portfolio strategies. We're going to keep you updated. It's not going to be dull. We hope you have a great week. Keep tracking us on social media. And also a big thank you. Last week, several of you forwarded our blogs to people, and we greatly appreciate that. And we hope you have a great week and know every day here we're striving to see to it that our clients have better, richer, fuller lives. Take care and thanks again.